Citibank is crashing and burning, and bankers are scrambling to put out the fires. What was once the largest bank in the world is now in freefall as controversies continue to pile on. From system mistakes to economy-shaking events, we'll be detailing every wrong turn that Citibank took to get to the low they're in right now. This is the downfall of Citibank. Stick around until the end of the video to see what the future has in store for this acclaimed bank. History. Citibank was first founded on June 16, 1812 by Samuel Osgood, William Few, Isaac Roosevelt, and John Mason. Originally being known as the Citibank of New York, the founders of Citibank began making waves by steadily growing and expanding their operations. The Citibank of New York has always been the frontrunner when it comes to banking services. Being in New York, the land of opportunity meant that Citibank was at the forefront of most inventions as soon as they caught a whiff. Common concepts we know today like the ATM, though not invented by Citibank, were popularized by Citibank as a way to access your bank account on the go. Another banking concept that was once foreign to us would be the use of credit cards. These pieces of plastic that made spending easier for everyone and made learning easier for the banks. In 1976, Citibank even became one of the founding members of the Visa credit card network and eventually went on to become the biggest credit card issuer in the company, an achievement that's since been overtaken by Chase. After rebranding to National Citibank, the company then started internally planning for their eventual foreign consumer banking, a concept that was literally foreign for most banks at the time, and for good reason. Handling a banking system that spans across borders is hard, but National Citibank was big enough to handle that stress. In 1919, they would establish their first foreign branch in Buenos Aires, Argentina, marking the beginning of the international network. Things were great for Citibank. They were now earning money worldwide, and as with every other bank, the more money banks earn, the bigger games they can play. In 1968, they would make what is probably the second greatest change to their company, finally adopting the brand of Citibank and saving us from a mouthful. We say second because the next step in their grand plan would rock the financial world: merger magic. While Citibank was the latest and greatest when it came to financial services, it wasn't the only giant in the force. Travelers Group was a company that specialized in wealth and insurance management, two things that Citibank also offered, but weren't on top of their game. It was like comparing the fastest car in the world to the fastest airplane in the world. Sure, they were both fast, but then someone suggested an insane idea. What if the fastest car in the world could fly? In 1998, Citibank merged with Travelers Group to form Citigroup Inc., creating one of the largest financial services companies in the world. This merger brought together banking, insurance, and investment services under one freakishly large umbrella. While company mergers of this size are the norm nowadays, this merger was insane and almost illegal at the time. This was due to certain laws and restrictions set in place by the government after the First Great Depression. Restrictions that would make sure no financial company would blow a bubble so big that it burst the entire company. But due to the happy-go-lucky era of the 90s to early 2000s, the government decided to become more lax with the situation and loosen up. Congress, seeing the ambition of Citigroup, basically were now convinced that this was the right direction to move the economy. And they were right for a while. Financial supermarket. Citibank became a financial superstar, and the markets were never happier. Money kept flowing in, and there seemed to be no stop to what Citibank could achieve. It was during this era where Citibank earned an estimated $2.1 trillion almost weekly, and in 2001, their share value hit an all-time high of almost $600. Citibank made bankers look cool, and they couldn't care any less. But while the company may be looking great on the outside, the wheels were starting to wobble on the inside. It turns out banking and insurance didn't work well together at the time. The money-hungry salesmen that wanted you to invest your money in stocks were the same people trying to convince old Grandma Joanne to buy life insurance. Not a good look on the sympathy department. This made it so some products in their financial menu just didn't work, and it was starting to affect the other products they had. It may sound worrying, but at the time, it was negligible. What's a few $1 million in losses when you're earning trillions, right? But then they heard a pop. Crashing down. At this point in Citibank's lifespan, this was a time Citibank thought it was too big to fail. A bank with that much cash in their vaults has access to something other banks don't: high-risk products such as the subprime mortgage loans. Subprime mortgage loans were supposed to be a win-win product. People got to loan money to buy houses, while bankers got more money through commissions. The only risk here is having to make sure the people the banks lent money to had to be able to pay it back, a risk overlooked by greedy bankers that were just motivated by cash. Then when it came time to collect Citibank's dues, they couldn't even get a single dime. What was once the biggest bank in the world was now suddenly out of the top 10, settling $100 billion behind the 10th place. The bank's stocks itself were now in freefall, stumbling from the mighty $500 valuation per share to under $1 in 2009. While Citibank got their subprime mortgages wrong, they were right with one thing: they really were too big to fail. Citibank is one of the biggest contributors to why our economy is what it is right now, and the government thought so too. To help the company back on their feet, the government issued a $476.2 billion bailout fund to help Citibank reclaim its losses and get back on their feet. But it's obvious from the start that Citibank was never the same again. As Citibank desperately tried to claw itself out of the hole it dug itself into, there was still a long road ahead and it was filled with turbulence. Citibank couldn't really catch a break after 2008 as they were met with controversy after controversy. Money laundering accusations, tax problems, and accounting errors swarmed the company en masse, leading to stakeholders selling their shares in frustration. Take for example their banking system mistake with Revlon, where they accidentally paid off makeup company Revlon's entire loan, amounting to $900 million even before it was due, resulting in a holdout of $500 million of their own money. Though they would win the money back in just 2 years, after a lengthy court case, the damage to their reputation and legal fees cost the company a lot. But this doesn't spell the end of Citibank, nor should it. While they're lagging behind a few trillions, they're still a huge bank that could just need fresh new eyes. Moving forward, while Citibank is still in shambles, there's no denying that it has some pretty good ideas moving forward. Led by current CEO Jane Fraser, the company now plans to trim all the fat and look out for their number one moneymaker. Their first step of the plan was integral: close off retail banking in foreign states. Having a banking company spanning across countries means that Citibank had to deal with multiple foreign banking laws while juggling the mess from 2008. And so they cut foreign banking and stayed close to home. After closing their foreign ventures, they began to look at their products. 54.7% of their profit was from institutional clients, big spending accounts, and corporations that need help with their own treasury and mergers. In fact, it seems Citibank has found their groove with treasury services because they're currently the biggest treasury advisors in the world. But while this streamlined vision for business does simplify things, the company still falls short. In fact, their revenue from wealth management services once again fell by 5% in the second quarter of 2023. Regardless of how the numbers look, Citibank is still scrambling for a solution to get them out of this rut. But the recent mass layoffs of managerial positions within the company speaks volumes about where the company is settling at right now. Only time will tell if these solutions deliver on their promise for profit. But for now, let's just hope they don't create another bubble.